Hey everyone! Further to my video dated September 16th, let's look into the bond market movement since then. Both short end, which is representing shorter-term bonds like the 2-year Treasury, and long end, which is representing longer-term bonds like the 10-year and 30-year Treasuries, have been falling, with the shorter-term yields falling the most. This change results in what is commonly known as a bull steepening yield curve. The words bull or bullish relate to the fact that bond yields are falling, and hence bond prices are rising. Steepening refers to the shape of the yield curve. Normally, a bull steepening trade results from traders anticipating easier monetary policy due to economic weakness and a growing possibility of recession. Given that shorter maturity bonds are more correlated to Fed funds than longer maturity bonds, they tend to fall quicker when expectations of monetary easing arise. The recent Fed's easing or rate cut, along with investors' expectations of further rate cuts, have a more immediate impact on the short end of the curve, pushing short-term yields lower. At the current level, the 2-year notes seem to have priced in most of the Fed's near-term rate cuts. So, if the Fed does cut rates further, what would the 2-year note do? Probably nothing much because it's mostly priced in. What would the back end or the long end of the yield curve do? It would rise if we continue to see a steepening. Therefore, a steepening with this setup is probably a bearish call on interest rates. Case in point, since the Fed lowered rates on September 18th instead of coming down, the yields on 10-year Treasury have been trending up. Alternatively, looking at TLT, from the time the Fed cut rates, TLT has only gone lower. It's bounced a little along the way, but the TLT continues to go lower, which means yields continue going higher in the longer end of the curve. So what could be the cause of this phenomenon? Long-term yields are influenced by expectations for future economic growth and inflation. If investors expect growth or higher inflation in the future, long-term yields might rise. The current long end of the yield curve that is not falling as fast as the short end of the curve may suggest a few things. 1. Moderate or persistent inflation concerns. If long-term yields remain elevated or fall more slowly, it could imply that investors expect inflation to persist over the long term, even if short-term inflationary pressures are easing. This would lead to higher long-term yields to compensate for the anticipated loss in purchasing power over time. 2. Uncertainty about future monetary policy. If investors are unsure whether the Federal Reserve's actions will be enough to bring inflation down to target levels in the future, they may demand higher yields on long-term bonds as a risk premium. 3. Economic growth expectations. If the economy is expected to recover or remain resilient after a period of high inflation, long-term yields could remain relatively higher. This is because stronger growth often brings with it upward pressure on prices, namely inflation, in the future. In the current environment, the long end of the yield curve could be signaling concerns about inflationary pressures in the future, even as short-term rates fall. Let's be reminded that the yield curve is just one piece of the puzzle, but it's a significant one. Stay tuned for economic data and Fed policies. That's all for now. See you next time.